All right. Last week we were looking at the balance sheet, financial statements, set of financial statements. What does it consist of? So people who are not very familiar with this, for the benefit of them, a set of financial accounts normally consists of income statement, or we call it profit and loss account, and balance sheet, cash flow statements, and notes to the accounts. So normally income statement for a period, what is the income earned, and income statement or profit and loss account is basically prepared based on the accrual basis. That means whatever relevant to that period is taken into account, either paid or not, right? So for example, for that period you would have sometimes paid the rental, or wouldn't have paid the rental, but then you take that into account. And when you are paying the rental, of course, that will be a balance sheet item, right? So you account for it. Like that, maybe dividends, if it is paid or not, if it is for that period, you account for it. Depreciation. So an asset which has been purchased some time back, the cash should have gone out for the asset, but what you do is you think that that particular asset is used for this particular period. So from the price of the asset, you capitalize that and then depreciate over a period of let's say 5-year period. So over a period of 5 years, 20%, 20%, 20% of the asset value will be charged into P&L by way of depreciation, amortization. So this is the accrual basis. Accrual means you wouldn't have incurred the expenditure, or you wouldn't have received the income, but you account for it, right? So income or profit and loss account, that is why we don't take that into account when it comes to repayment capacity of a business. Repayment capacity of a business for lending purposes for the bank, we don't profit and loss account is important to really gauge what is the profit the particular business gets. But more than that, whether they had liquid cash to pay, that is what is important. So that's where the third one what we are mentioning comes into takes the importance. Cash flow statement. That's why for the banker, cash flow statement is very important, because cash flow statement will say at the beginning of the year what may be the liquid cash the business had, how much is paid by way of operations, investing, and what is the other area, right? So how much cash has gone out of the business, how much cash has come inside the business, end of the period, what is the cash balance. So from that only we are looking at whether the business has sufficient cash flow to service a particular loan, because paying the loan means it is not on accrual basis, it is recovery, right? Cash has to be paid. So that's why cash flow statement is important as far as the bank is concerned. So now we attach importance to cash flow statement. So income statement is like that for a particular period. Now, like for maybe January to December, or April to March, right? Financial year can be different. For the banks, normally banks and financial institutions, mostly we have this January to December calendar year as the financial year. But many of the companies, corporates, their financial year starts from 1st of April to 31st of March of the following year, right? So based on that only, even the tax year is like that. Like tax is paid according to that particular thing, right? Then balance sheet. Balance sheet gives the assets, liabilities, shareholding of a business at a particular time, at a particular date, asset something, right? So that is asset. Asset means as at on that particular date, what is the position of the business, how much of assets the business has, how much of assets if you divide into current assets and long-term assets, then liabilities, current liabilities and long-term liabilities. Normally assets and liabilities, you like, I mean, you know, whatever which is falling due or recoverable within the 1 year period, we call it current assets. So you have a 1 year horizon period, or more than 1 year. Normally you put it to the long term. So 1 year and longer, more than 1 year means that's long term. So that way you assets and liabilities, you divide it in, put it in the balance sheet. Balance sheet essentially is a position statement on that particular time date. On that particular date, what is the position? That's why we call it balance sheet as at 31st December 2020. So it is asset. If we don't say balance sheet for the period ended 31st December, no, it is not for the period ended. It is not. We were not calculating for the period. It is on that particular date. But how much is the asset? How much is the liabilities? How much is the shareholding? What is the net worth and all that? I mean, that is what is about balance sheet, right? So then we looked at notes to the accounts. Normally, what happens is that in the income statement, in the balance sheet, it's difficult to sort of give the full explanation for an item. For example, depreciation, if it is charged in the P&L, you don't know depreciation, how many assets for which, what is the total of that? I mean, you can't, you won't say depreciation for car separately, depreciation for vehicle separate. The office building separately. Like, it is not that. I mean, you take the we put one figure, but then the breakdown will be given in the notes. So anything where explanation is needed will be found in the notes to the accounts. So normally, alongside the item in the profit and loss account and balance sheet, the number will be mentioned 1, 2, 3, 4, 5, 6, 7. So that that will be explained in the notes under those numbers, right? So that makes makes you to understand, to make you understand the profit and loss account and balance sheet. What are the items? What is the breakdown of these? What does it consist of? All those things are available in those notes. So notes also a very important part of the set of accounts, right? So normally these four are the important parts of final accounts, right? So whenever you are analyzing accounts of a customer, you need to have a set of this, right? From this only you will be analyzing, right? The other tool in as far as we are concerned in analyzing balance sheet to kind of have a yardstick, how does the profitability of the business does, how is the capital accumulation, whether they are able to repay, whether they are liquid, how the assets are being used, how the assets are being turned over in producing the turnover. All those things we normally do a ratio analysis. So ratio analysis normally throws light into the operations of a business, so that you will be able to kind of understand. So when you do a ratio analysis, what is the industry norm and how much is the business is doing, like those ratios comparable, kind of comparable and say. So say, for example, an industry, a steel industry, they are having the industry norm is that about 15% gross profit margin means if the business is showing gross profit margin of 13%, just about there, like, just about there, the business is doing sort of all right. They are about close to the industry margin, like. So if it is like 20% is the gross profit margin, then you say the company is doing better than the industry, right? So that's like, ratio analysis. So ratio analysis basically we have to do for minimum 2 years, and then we need to look at a minimum of 3 year period to sort of see how whether the performance is improving or deteriorating. So that's the very reason why we sort of, when we are doing an analysis, balance sheet analysis, we go and do for about a continuous period of 2 years minimum to sort of look at it. So normally in your sons, for your exams and all that, a 3-year balance sheet will be given, 3-year for the 3-year period. From that, comparably, you can do the ratio for a minimum of 2 years and then do the comparison. 3 years or 2 years you can do. All right. So I say about the introduction about these particular financial statements which we looked at. And I told you about qualified or unqualified also is important for a bank. Why? Because if an account, a set of accounts, if the auditor says it is qualified means they have something to say that, I mean, there is something which the company has not complied with. So the company has not complied with this, so the accounts are qualified. That means, let us say, a particular accounting standard not followed. There is an exception. The company has not followed a particular accounting standard, or the company has not followed what they had been doing last time. So I was telling you one particular company, a big tire company, some time back, I saw that, I mean, auditors have qualified. Then I went and looked at the balance sheet, what has gone wrong. The auditor said the company had been depreciating the assets over a period of, there's a big, machinery where they are using it to produce tires, and that they were depreciating over a period of 5 years. Then they mentioned a clause in one particular account, year. They said the economic life of this particular machinery can be easily 8 years, so that the management has taken a decision to extend the period rather than depreciating in 6 years or 5 years. We decided to depreciate over a period of 7 years. So if we say 100 million is the worth of the asset, now what you say, for 3 years you have done 20. So already 60 million has been depreciated. Now you decide that, I mean, it can be extended up to 7 years. Then you rework it, right? Rework it. So over provided for 3 years, and then you rework it, and then so that what will happen is that when you look at let's say 7 years, the amount you are to go and depreciate will be less. For example, if it is 100 million is the worth of the assets, in 3 years you have depreciated already 60 million. So 100 million divided by, if you extend the depreciation period to 7 years, then what happens is that every year you have to depreciate only 14.2 million. 14.2 million into say 3 years, as about 42 million only. So 42 million means 42.8 million, another 14.2, altogether for the current year, the company is not depreciating, is not charging anything to the P&L. That means, for example, say 42.8 plus 14.2 is about 57 million. 57 million only for 4th year also. So they are not going to depreciate for the 4th year. They say this story, and then extend it, depreciation period extended by 2-year period. And actually there is even over depreciated, like another 3 million also is balanced there, that can be taken into account for the next year also. So then the auditor said, no, this company is not consistent in the policy. All these 3 years they had been depreciating over a period of the asset was depreciated, keeping in mind that in 5 years they are going to depreciate, and then now they are extending it up to 7 years. So there is no consistency in the policy, accounting policy. But as far as inland revenue is concerned, they for the tax payment, they give specific period. Normally it's like 5 years. so the depreciation which can be claimed in the accounts for tax purposes will be, I mean, they can do that for 20 million. But here the company is taking a decision, and then for the for the published accounts, they are doing this way. So which is not consistent. So the auditors say they qualify. That's qualifying, right? Like that, any of the company or customers who have done accounts where the auditors find that, I mean, there is inconsistencies in preparing, in identifying, like in recognizing income or profit, so in charging to P&L, like, I mean, if there is any violation of accounting policies, so like or else anything which is not consistent with the past years, which is not supported by any change of accounting policy, then the auditors will qualify. So if it is qualified, then we have to go and see why it is qualified. Then for bank purposes, we might even prepare it. Like in this case, let us say we may go and charge 20 million to P&L and see what is their profitability for our purposes, right? P&L, they haven't charged 20 million depreciation. We go and charge what may be the profitability. Whether profitability has come down, why the company has gone and done that. That part we will look at it. So still whether it is worthwhile for us to continue to lend or consider a new lending proposal. So that's about qualifying, right? Qualified or unqualified. And we also will look at two other auditors. Sometimes like, I mean, big companies and all, you will find that, I mean, auditors, recognized auditors would have audited because their charges are high, like KPMG, Ernst & Young, like that kind of companies would have PwC, that kind of companies would have. Some there are many other small firms also there. There are some unqualified accountants also who do the accounts and get it signed by somebody. That also is in the market. So we'll have to be careful about who is auditing, who has audited. Also is important for us, right? And like what I told you, accounting policies, if there is any exceptions, we are even if the auditor has not qualified, we may have to look at that, whether there's any exceptions they have done this year. That's important as far as bankers are concerned. So we were briefly looking at the P&L account. I told you business turnover, cost of goods sold. Now, if it is a factory environment, you will have, like, I mean, number one, turnover. From that, you will charge what is the contribution? Like, I mean, for the production, how much is the cost, and then factory overheads you will charge and all that, and then you will get the trading profit, and then only after that, only from the trading profit, you will charge other overheads, and then come to kind of a net profit. So otherwise, what happens is that business turnover, cost of goods sold, gross profit, then operating expenses, selling, distribution, administrative expense, overheads, and all you charge, and then you get the other operating income also included, and then you charge the finance cost, you charge then you get the profit before tax, and then you charge the taxes, and then profit after tax you get. So normally this is the way the P&L account will appear. So I told you the basics of balance sheet is that you get two sides of the balance sheet. One is asset and the other side is liability. Now on both the sides, what happens is that asset side normally will consist of fixed assets and current assets you will have, and liability side you will have whether long-term or short-term liability plus equity. So now what happened here, what do you mean is that your assets are financed by the combination of your equity, how much is contributed to the business, plus other liabilities by way of borrowing. As far as the banking is concerned, you will find equity part is there. On the liabilities, you will find that we have taken deposits from, that's where we studied about the fundraising. I mean, multitude of means of raising funds. So that forms the liability part of it. So that may be either deposits from customer deposits, or interbank borrowing, or it can be issue of other instruments in the market, commercial paper, debentures, and all that kind of things that are taken, borrowing from the interbank market. So various ways. So we looked at so many instruments in fundraising, right? That forms part of the liabilities. And the how we also learned about how a banking company, a financial institution differs from the other companies in the market. How does it differ? This liabilities part will be quite high when it comes to financial institution. Why? Because we leverage like 10, 12 times we leverage equity. Liabilities may be about 10, 11 times of the equity, right? So we also looked at that any other business, if they have that kind of a structure, we will not go and finance it. You say you are highly leveraged. So it's very risky. But when it comes to financial institution, what happens is that's the style. There is a style because we are in the business of financial intermediation. So finally, financial intermediary, there will be a lot of the funds from the public and then other institutions in the market, multilateral funding agencies you would have borrowed, IFC, ADB, IDB, right? Or the multilateral funding agencies, other DEG, like German funds, kind of we would have borrowed from all over the place, refinance borrowings, all that we would have taken. So that forms part of this particular liabilities, bigger part, and equity will keep on increasing with when we are having so our equity, what is contributed, what is the retained profit, with that it will increase. So maybe time to time we would have issued the shares, we would have issued rights issues, we would have capitalized the profitability, right, by way of issuing rights issues, bonus issues, and all that. So that forms part of the equity. The equity will grow that way. So with retained profits and then other share issues and all that, it will grow. So normally equity or the net worth of a business, how you identify it? It is the same formula. You asset minus liabilities equal to equity. So that shows you how if the assets, if the liabilities are high, if the borrowed funds are high, then equity will be lower. So when it comes to banking company, it is like that. Banking companies, assets minus liabilities, if you look at it, financial institutions, you will find a small equity. But other businesses will expect that there is equity, considerable part is there, right? That's why anything we are looking at, and then when we are going and financing a particular business also, we say, okay, you put 25%, we'll put 75%, right? 25% equity should be there for any new investment. We will put 75%. So you introduce 25, then only we'll give you 75%, we will say. And there are riskier businesses like like people are going and investing in margin trading, investing in share market and all that. We might even reduce it to 50%. We'll say, okay, if you want to invest 100 million in the share market, you bring in 50 million, we will invest, we will give you 50 million. It has 50% margin, right? So like that, any equity portion of any business, if you want to identify, normally you will take your total assets, how much is assets are there, minus liabilities, you will find the equity. So the higher the equity, the more the better for the business. So then we went and looked at the cash flow statement, how it is being prepared. So I was telling you the financial accounts prepared for a business. We normally won't go and prepare, and we don't go and dwell on how the financial statements are prepared, and then we don't go and prepare financial accounts for a particular business. But we try to identify what is needed for lending from a set of financial accounts. Many a time we don't 100% go and rely on the financial accounts also. Sometimes people do prepare accounts for tax purposes also, right? So there are many businesses in the market who are not really 100% declaring their turnover, their income, their profit, right? Sometimes they prepare it for a lower amount so that they pay low taxes. So when we are doing lending decision, we take that into account too. So now we will see if there are many ways for us to go and see that whether the correct turnover of the business is represented in the accounts, that we can find out. For example, if you see that, I mean, in your statement, let us say he is solely banking with you, or he is banking with two banks. What are the credits which have come? When you total it up and see business proceeds which are coming into the account, whether it is conforming to your turnover mentioned in the profit and loss account, sales turnover, I mean, it will give some indication, right? And if you go and see that what is the day's business, how much is the day's business, and then you just look at for a month how much it will be, for a year how much will it be, it will give you a rough idea how much is the business turnover. Then when you look at the P&L, you will understand whether whether that is reflected. There can be deviations, but then there can be there can't be large deviations. So that kind of ways you can find out whether the customer is actually giving the correct figure or not. So if the customer is showing a lower figure for tax purposes, probably his repayment capacity will be higher, which we might think that their repayment capacity is lower, so that they can't pay the loans and all that. So those kind of guesses a banker will take, right? Right. So I told you about cash flow statement. Now the cash flow statement basically will throw out, like what I told you, like at the beginning of the year, how much is the cash with bank and cash in hand, how much was there. With that, you divide the operations of the business into three. So what is the operational? That is the business operations. So how much of cash came, how much of cash went out. Then you look at the investing, continuously a business need to invest. They'll be investing in assets, they will be investing in other infrastructure facilities. Sorry. Yes, so purchase of assets, and then they will be going and investing in, let us say, so many other instruments also. When they have excess cash, they can go and put in treasury bills, treasury bonds, and kind of deposits. They can make deposits and all that. All these kind of things are also is going out of the cash flow. So how much of cash received? Sometimes people would have been selling their financial assets. They would have sold their fixed assets. All that will come as an income. So what happens is that, so you calculate these operations, investing, financing activities, how much has cash come in, how much of cash gone out. So end of the year, you will know that how much of the cash flow. So now, if it is a negative figure, you have a concern. Now, how are they financing this? Right? Whether it is that the one we have to look at, right? So whether that is going to improve with our loan, we will look at it. And whether basically we will look at it, whether that is enough for them to service our loan, the capital portion and interest portion, whether they can do that, whether they can pay back that you will look at. So normally cash flow statement, like what I told you, consists of 3 areas: operation, investing, and financing. So there you will take into account all what is coming in, all what is going out. So operations means in business, what is going out is your purchases, right? Inventory purchases, other expenses, your overheads, right? Operating, administrative overheads expenses are there. Then interest would have been paid, income taxes would have been paid, all other relevant to operations. So all those things are reduced, and then cash received from the sales. Actual cash received. This can be relevant to previous year or future year or whatever, like whatever cash came, you will take into account as credit. Others are minus. Then you know that, I mean, from operations, how much is the cash flow generated. Investing activities, how much of cash received from your sale of, property. So like, from any loans given, what is the principal and interest received, or like, so any financial assets, investment securities which are sold, how much cash flow generated. And then from that you will deduct whatever investments which are made, whatever purchases of any property or equipment which are bought, like which are assets to the business. So you deduct it. So you know that, what is the cash flow generated, whether negative or positive cash flow generated from the investing activity. Then you come to financing activities. They are basically financing activities. What do you do to finance the business, right? What you do to finance the business. So finance the business, you would have basically taken this is fundraising, basically what you learn. Financing, fundraising for the business. Fundraising for the business is like whether stocks are issued, whether rights issues through which it is issued, whether debentures are issued, whether commercial papers are issued, and then money raised, right? Cash received, or you borrowed, bank borrowings, right? Then cash paid for any repurchase of asset. This normally, the repo what we have, like, you normally what you do, selling and buying back. There's a repurchase agreement we learned, selling and buying back. At a certain point of time, what you do to raise funds, you give your treasury bills, bonds, and then raise funds. Then thereafter you pay the money and then take it back. That's what repo, right? Repurchase of stock and repayment of loans and dividends, dividend payment. These are all the financing activities, whatever money which is going out, right? So that comes under financing activity. So then with that you get the net cash flow from the financing activities, all three together, along with the cash at the beginning of the year, you get the net cash, right, amount of money which is increased during the year, right? And that total cash at the end of the year, you find out from that. This is one way of doing the cash flow statement. There are two ways that people do. Number one is that they take the cash balance at the beginning of the year and then do the adjustment for the inflow and outflow in operating, in investing, and in financing activities. The other way of doing that is P&L figure they will take. They take the P&L figure, right? What is the net income, net profit from the profit and loss account, they take it. From there, they go and adjust it. Non-cash items, they adjust it. So from that, non-cash items are like, if depreciation charged, you add back, right? Any provisions charged, these are actually cash did not go out of the business, but we have accounted for it. You add back, right? So like that, you add back gain on sale of facility, that you deduct it. So this way, what you do under this method is that you take the P&L figure and then you work it backwards. You add all the cash items. You add and deduct all the non-cash items, so that you come to the cash position, right? So in all these three, that is the same thing which is happening. Cash flow from investing activities, purchase of property, right? How much of money which has been paid is taken into account here, because purchase of property wouldn't have come to P&L, right? Profit and loss account has not come, but cash has gone out, so you deduct it, right? So here the items are of that nature, right? Dividends paid, right? Dividends paid means actually it would have been accounted for another period, but what happens is that current period it is not accounted for. It's a balance sheet item, right? But cash has gone out. Normally, cash is debited, cash is credited, and then dividend payable is debited. So that amount is deducted here, because cash for dividends being paid when it's a balance sheet item, not appearing in the profit and loss account. So this is kind of, you work backwards, right? Take the P&L figure and then add and deduct all the non-cash items from the profit and loss account, non-cash items, or the items which were not taken into account into the P&L, but it happened during the period, right? That's why in the investing activities, you will find the items which normally, you know, when you are issuing a common stock, which is not coming into the profit and loss account, right? So you are issuing equity, 150 million you raise from equity. So that normally will come to cash, and your equity would have been credited, cash would have been debited. So that's how when you are raising equity. So that only affects the balance sheet, not affecting the profit and loss account, but cash has come in. So you will add it there for investing activities. So the financing activities. So like that, you are under this method, what you are doing is that you are going and adjusting the net profit to that of the actual cash flow during the particular year to arrive at the cash and cash equivalents at the end of the period. So if you understand that, that's sufficient for you, right? If you understand that, that's sufficient for you. How do you understand that? Cash flow statement, why it is important? So cash flow statement, normally you will ask, even if somebody comes and says, okay, I'm going to start a project, you will say that, okay, I'm going to put a factory, and this particular factory, of course, it will take a period of gestation period is about 3 years. Like, I mean, for me to put the factory, put the machinery, everything, go into commercial production, and then commercial production to be sold, and then cash flow to come in, it might take about 3 years time. So from third year end, you will find cash flow coming into the business. So you will say, okay, you prepare a cash flow statement. So first year, so much of capital investment, no cash flow inflows. Second year, so much of investment, no inflows. Third year, also some investment. So then you get the cash flow coming, starting to come from third year. So you will put that. So you ask the customer to prepare a cash flow statement for you to see whether I can go and finance for this factory. Is it feasible? From the income what these guys are going to generate from the third year, whether it is feasible, whether they can pay the loans, right? Whether I'm satisfied with that. For that you will say, so specific cash flow you will ask for a particular project, right? So whether it is for a particular project or whether it is for the financial year, or cash flow statement is very important as far as you are concerned. Any questions up to now? Do you have any questions? Anyone did not understand up to now what I said? So the basis of your 40-mark question is this. All what we looked at it now. In the basis, this you should understand. What your income, balance sheet, cash flow, right? Then is what are the components of your income statement, and how does your balance sheet, what do you understand from your balance sheet, what do you understand from your cash flow statement, and then with that understanding only you are going to go forward in looking at your decision of going and lending to a particular business. So this is important for you to understand. So anything anybody did not understand, would like me to repeat, would like me to elaborate on anything, please ask me. Next, we will go into financial analysis. We'll go into, what do we understand by the ratio analysis, and then we'll go into that. Before that, anyone? Are you okay? Are you okay? Everybody understood?
Yes, sir.
Right. No questions. If you are a lending officer, your ability to do financial analysis of the set of accounts what we get from the customer, and for your ability to grasp it and then take what is really necessary is very important. It's very important for you to, when you look at it, you should be able to understand. Now you are not going to be guided by what kind of assets the customer has. What I used to repeat to you, somebody can come and tell you that I have a property at Colombo 7. That property is now worth about 75 million, and give me 10 million. And so now then he will tell something which I'm doing some business or something like that. Now from the business, if you are not able to really identify and see whether this guy is having a business and then which is generating a cash flow, which is generating a constant business, which can repay the loan, even though the asset is worth 75 million with high market value, saleable asset, is not going to matter to you. It's not going to matter to you. As a lending officer, you will see the time you are not satisfied with the business, you will not go and lend it. You can't take the customer's asset into account. Customers have this dilemma. They have this dilemma, like, I mean, they're telling that, okay, well, I'm having so much of assets and this bank is not giving money to me. The bank is, number one, looking at the purpose for which it is used, and then whether that particular purpose is going to give you money. Except in case of some housing loan where somebody showing employment income or some income and asking for a housing loan. Other business purposes, if you are lending, you need to know whether that business is a viable business, right? For that, financial analysis is a very important tool, right? So theoretically, we say that it's a process of selecting, evaluating, and interpreting financial data. It's an art, I told you, right? So you look at, how do you, from the set of figures what the customer gives, what are the things you will select and evaluate and then interpret to identify the strength of the business. Is an art, right? That's about financial analysis. So from that only you will form a assessment of the company, and what did the company did in the past, what the company is doing now, what the company is going to do in the future, for you to base your investment decision, in the sense lending decision. Right. So there are so many things you will look at. I mean, you will look at the market data, you look at the financial disclosures, and you look at the economic data, all that you do to get a financial analysis of the business. There are many ways in which you do analysis. A statement when you took, you do many ways. So there is different people adopt different ways of analysis, right? In this case, what do you understand by common size analysis? You do a common size analysis because in an industry, when you have companies which are big and small, their turnovers are different, profit volumes are different, like the assets are different. With that, if you want to have a kind of an understanding of, okay, from the turnover, all right, from the turnover, what is the percentage they are having as gross profit? What is the percentage they are having as net profit? What is the percentage they are spending on their overhead cost? What is the percentage they are paying taxes? Like that, if you want to have percentage, so you make a common sized analysis, right? So you restate the financial statement information in a standard format so that you will be able to compare businesses, right? Compare different businesses. So you can have a horizontal common size analysis or vertical common size analysis, right? This is for your knowledge I am doing, but don't worry that I am not going to ask you that you do a common size analysis of balance sheet and all that. I'm not going to ask you. But you should understand what is a horizontal common size analysis and vertical common size analysis. So horizontal common size analysis, what happens is that you look at a particular year as the base, and subsequent years. Now, like your what do you call it? Cost of living index. It's like that. Your cost of living index is that of one particular year they will take as a base, right? So that the base is 100. Compared to that, how it is increasing every year, right? Year by year it is increasing. That's a common sized analysis, right? It's a vertical. It's a horizontal thing. It's a horizontal thing. Yeah. So useful when comparing growth of different accounts over time. So for example, if you see one company, right? Now this is how the the accounts appears. Their cash, inventory, account receivable, net plant and equipment, intangible, and total assets is how much. Now this only giving about the breakdown about the total assets. The total assets are consists of these things. So over a period of time that changes, right? So I'm just giving 2008 to 2013 how it is. So what do you understand by vertical and what do you understand by horizontal? Now, if it is kind of vertical, what happens is that for the particular year, you total amount, you make it kind of 100%. Of that, what is the percentage other components have, right? So cash is how much, inventory is how much, account receivable is how much, net plant and equipment how much, intangible. So what happens is that here you find that 6.5 million is normally, okay, $6.5 million, that is a total. Now total of that cash is how much? So that you put cash is 6%, inventory 23%. So now when you do that, for every year you do that, I mean for the total, it consists of what? Then what you do, you compare this across the Here how that changes. Now cash has come down. Cash component of the total asset has come down from 6% to 5%. Inventory also 1%, it has come down. Account receivable also is coming down, has come down. Plant and equipment asset, investment in the plant and equipment, that as a percentage, that has increased, right? So plant and equipment, I mean, if you can see your reduction in your cash, reduction in your inventory, as you can see the effect of plant and equipment has increased, right? So they reduced by percentage, here it is increased. So looks like the company has invested more on the plant and equipment, right? And so that the inventory and cash as a percentage of the total assets has come down by 1%. So you derive something like, I mean, how it happens now, like intangible assets also has come down. So this is a common size analysis, vertical common size analysis. So, but when you look at the horizontal analysis, the 2008 is the base. So 2008, whatever expenses, whatever balances in the cash, inventory, account receivable, net plant, all that is equal to 100%. So whatever increase in the subsequent years from that is as a percentage of the base year, it is mentioned. So when you put that, cash with a base in 2008 is increased by 5.1%. Inventory increased by 5.93%. Account receivable, like over a period of time, it has increased to 110.141%. Right? That means account receivable has shown a higher growth. Plant and equipment has shown an even higher growth. That's what earlier also we looked at. It has increased 100% based to 121%, 121.67%. Yes. Intangibles have grown. Total assets have grown to 116 by 16% compared to the base year. So this is basically. So when you're doing a horizontal common size one, you take the base year as 100%, and when you're doing a vertical thing, what you're doing is we are taking the total and then every year individual components, what is the percentage of the total you keep it. So this is about doing a common size analysis of any figures which are given. You can do this for your figures what you are extracting from the profit and loss, figures you are extracting from the balance sheet. You can do it. Any questions here? This is a way of you comparing the performance of the business. Right? Common size analysis, we call it. Then we go into financial ratio analysis. Right? Now, normally for this course, we divide the ratio analysis into 4 areas. Now, by way of introduction, ratio analysis is a relative thing. It's a relative thing relating 2 figures or 3 figures or multiple figures in the financials, relating and giving a particular parameter, which is kind of, from that we try to derive a meaning, right? Which shows, indicates something to us, indicates something to the business, indicates something to a lending institution, right? So you look at it and do the ratio analysis, and then look at it. I mean, so that you know that, I mean, okay, for the company this is the ratio, for the industry this is the ratio, whether it is acceptable, whether it is not acceptable, whether with this the company can is it comfortable to service if a loan is given. That kind of decision you can take partly based on the ratio analysis. So it's a comparative figure. Normally what happens is that for different people do ratio analysis in different ways. So it need not be the same. Slight differences will be there depending on the figures which are taken to compare, right? So the most important part is that what is the logical conclusion we derive from the figure what we get, right? Based on the numbers we are taken into account in preparation. So normally ratios are like under 4 headings. We look at the ratios, which are activity ratios, liquidity ratios, solvency ratios, and profitability ratios. Now, solvency ratios of performance, right? Okay. Activity ratios, like how is the company, how effectively they are putting the, assets to productivity. That is activity, right? So I used to look at a particular balance sheet where this particular company is having a huge investment portfolio. It's about 2 billion. 2 billion investment portfolio they have. They don't do anything about it. They just continue to be like in that like, I mean, that only shows a good net asset value per share, but that's not really invested somewhere to improve the income, increase the turnover. It is just that, I mean, when we are going in investing into a long-term share and waiting, it's just not turned over. It is just there. Or like, I mean, something which is invested in a landed property, which is just there, which is not turned over, but it appreciates over a period of time by way of capital gain, right? By way of capital gain. So for your information, capital gain means what? Your investment, when that is increasing in value, in capital value, if it is increasing value, the price at which you have bought and then the current market value is what? The difference is what? Is the capital gain, right? So when you are selling, that becomes your capital gain. So when the activity ratio of a company, like what I told you, where they have a large amount of money which they don't put to maximum use, so the activity ratio will be less, very much less, showing that, I mean, they are not using their full potential. So they could have used the potential, but they are not using the potential. Like that. Liquidity ratio basically is very important as far as the banks are concerned. Why? Because from the liquidity ratio only, we are going to see whether the business is going to be able to meet the short-term commitments, right? So the better the liquidity ratio, the better the proposal for us to go and lend to that particular company. The other one is the solvency ratios, ability to satisfy the debt obligations, whether they can meet the debt obligation solvency ratios, and the other one is profitability ratios. Profitability, you will look at all the type of net profit, gross profit, all these profitability ratios you will look at. So those are the 4 ways you are going to look at your ratios. Now, in activity ratios, activity normally deals with the turnover, right? The turnover, business turnover. Now, if you look at your purchases, the purchases for over a period of time. Now, like the company would have, let us say, during a year, 6 times they did the purchases, right? So every time they purchase 2 months, they can keep it. So 6 times they had done the purchases. So 6 times the total of the purchases will be the cost of goods sold. And you look at what is the inventory, average inventory. Like sometimes you will put 2 years together and then take an average inventory. What is the, let us say 2019, 2020, like 2 years inventory, you put total it up and divide it and see what is the average inventory. The average inventory, when you take the total cost of goods sold, and then you divide it by the average inventory, it shows how many times the inventory has turned over, right? How many times the inventory has turned over. So now, like the more means, like let us say, if it is 6, it is 6 times turned over. So inventory turnover period, if it is 6 means, then now let us say now, like like what I told you, every 2 months they are purchasing, and then 6 times they have purchased, and then total. So what happens is that total cost of goods sold divided by average inventory will show you 6. Every month if they have done, it will be 12. So that if you want to find out the inventory turnover period, what you will do is you divide the number by the you divide 365 by that number, right? So if somebody has bought every 2 months, like it's like 60 days, right? So that you will get 365 divided by 6. Number of days will come, right? Number of days will come. So that's how you find out the inventory turnover period. Inventory turnover times, if you are mentioning by times, you must say how many times? 6 times in this case. If it is by period, it will be let me put it on the board for you to, if you don't see that inventory turnover period. So like what I told you, let us say inventory, you have 50 million inventory for the year. Cost of goods sold. Cost of goods sold is equal to 300 million. So inventory turnover, you will have to mention by times. That is 300 divided by 50. This was cost of goods sold divided by inventory. So this was equal to 6 times. This was 6 times. If you are asked to give by the number of days, what you will do, how many times? 360 divided by 6. So 60 days. So that's what you will understand. Either you will have to give by times, or you will otherwise you will give by days. So 6 times it is turned over during the year, or 60 days. So while you are answering, that you must mention whether it is times or days. If you just simply mention 6, we will not understand. People will not understand. So this is the reason, right? So how many times the inventory is turned over, right? How many times the inventory is turned over, right? So inventory is turned over 6 times. Right? 6 times as a turned over. So the turnover period is 60. So while you are answering, while you are writing your answers, I have seen many a time people don't mention that. So you need to understand why do we mention that inventory turnover. So receivable turnover, basically inventory is talking about cost of goods sold, right? It is the cost at which we have bought the goods. But when it comes to receivables, it is receivable is that particular receivable is including our profitability also, right? Including our profitability, that is always connected to the revenue, right? For how much we have sold, right? For how much we have sold. So receivable turnover. So receivable turnover is basically the sales turnover or receivables. That is actually, you take the, numerator has to be the total revenue, right? Total revenue, the sales or total revenue, sales figure that you find in the profit and loss account. Top figure is the sales figure, sales. So sales divided by receivable, right? Because in both that, on the numerator as well as the denominator, you will find the profit part is included. That's the difference. If you look at the inventory turnover, inventory is basically without the profit. So inventory figure is shown in your balance sheet as a current asset inventory that doesn't include the profit figure. Like that, cost of goods sold also total purchased amount which is sold during the year. So which doesn't have the profit figure, right? It doesn't include. So don't go and mix up there. So students go and mix it up. Receivable turnover, basically looking at the turnover, sales divided by the receivables. Sales divided by the receivables. So the same principle like what I told you for the inventory turnover, receivable turnover also is like how many times. So if in your balance sheet, if you have like what I told you, say the sales is 600 million, let us say, average receivable in the balance sheet is 100 million. That means the turnover 6 times it has turned over, right? 6 times it has turned over. So 6 times it has turned over. Now the same way you will say that, I mean, the customer has paid every 2 months or something, right? Customer has paid every 2 months. So that's the credit period given to the customer. Total asset turnover is the other turnover ratio. Asset turnover, what does it mean? Is that you look at the total revenue and then divide by average assets. So it shows that now how many multiples of average total assets is the total revenue. That means your sales is equal to how many multiples of the total assets. That means what? How many, like how many times the total assets has been turned over to produce this revenue. Like what I told you, the revenue in the company example where I told you that, I mean, there's a company which has a higher investment in the equity. They just keep it like, I mean, liquid form in investments and securities, about 2.5 billion, which is not turned over. So the total revenue is less. Revenue will be less, right? Revenue will be less. So average total assets, when you take with all these things, when you take the overall total assets, and then how many times it has turned over, it may not be even once would have been turned over, right? Now these are relative terms. So when you look at the balance sheet and P&L, what is the total revenue? From the P&L sales, you will take what is the total revenue. From the balance sheet, you will take what is the total assets, and then you divide the assets by the total revenue by the total assets, and then you will see how many times the total assets are turned over. The higher the turnover is, like the business is more active, right? It depends on the particular business industry also. Like say supermarket chain, they will be having a higher turnover, right? The total asset turnover will be much higher compared to the steel business, right? Turnover will be not that much, right? So it depends on the industry. Working capital turnover. You will look at the average working capital is how much. Do from the balance sheet, asset minus liabilities. You will say that, I mean, current assets minus current liabilities. You will get the turnover. Working capital. So working capital, revenue divided by working capital is that how much the working capital is turned over, right? That also is an indicator. We have to say that, I mean, you have so much of working capital. How many times you have turned over the working capital in the business? It shows. That shows that, I mean, whether the business is turning over, right? So that is about the activity ratios. Right? I mean, we will do a couple of past papers, then you will understand, right? In the next classes, we will try to do a couple of past papers that you will understand. Right, that's about the turnover ratio. Then you should understand a business operating cycle. A business operating cycle, basically what happens is that one way is that business can buy from cash purchases. They do cash sales. That's very simple, right? They bought for cash from that point. What is the holding period? Okay, 10 days it was in the stores with them or in the shop, and then they sold it off, right? So this is like the vegetable, let us say. Vegetable, the people in the vegetable shop or the supermarkets, they buy, say they pay by cash and buy, let us say, and then it cannot be more than 1 week in the stores. It will be sold off. That's cash. For the cash, they turned it over. So that's a very simple cycle, right? So from the time of purchasing to the point of, from the time the inventory came into the stores to the point the inventory went out, and then cash was generated. Very simple. In 7 days, within 7 days, it is turned over. Only in case of, like I said, the supermarket and all that, they are paying the other party after 1 week or something like that. So there is a period, right? Now, normally in many business, what happens is that the businessman buys on credit, right? They buy on credit. So the inventory comes to the stores and GRN signed, good received, not signed, and then the inventory has come. And from the time inventory has come to the time the amount is paid, that is the credit given by the supplier. Supplier gives a credit, right? So that is in the stores. The goods are in stores, or goods are immediately sold also. It can be, it can be in the stores, and then over a period of time they will sell, or else maybe immediately also is sold. But the business, they are normally the businessmen have influence over the suppliers. So because supplier want to sell the item, they will give a credit period. So even if these people sell goods immediately, they may get a credit period from that fellow, so that these fellows will roll over. What is happening in the moratorium period now? The banks, we have given moratorium to many customers, but who are doing business, who have turnover, can pay the loan, but they got the moratorium period, so that money they will roll over in the business. That's their additional working capital. They will roll over and try to create more business. If they are creating more business and more income, and that's okay. They go and put into fixed asset is the problem. Some investment, share market is booming, so going and putting in the share market or going and putting in the in a vehicle or property is the problem, right? So there's a side effects of moratorium, because customers will say that, I mean, central bank has given, you must give. So you also can't go and say that no, you have some business, you can pay or whatever. They will not listen, right? So this is so number of days the inventory what you are keeping without paying is that that's a payable period. Number of days of payable, you have a payable period. And then the other side is what? You sold it, right? You sell it on credit. So like our supplier, the buyer also, the demanding buyers we will have. So they also will ask for a credit period, right? They also will ask for a credit period, unless there's retail credit. We are doing retail customers selling on cash. Except for that, others will ask for the credit period. So for them, you give a credit period. So number of days of receivables. So normally, what happens is that when you take the full cycle consists of, number one, the inventory from the time inventory came, how much of period you have enjoyed to pay for the inventory, and then from the time the inventory has gone out of the stores, how much of days your customer enjoys. This is receivable, right? Number of days of receivable, right? So that's the full cycle from the point the inventory came to the point the cash came to you, right? That's the cycle. So how do you calculate? Normal operating cycle is the number of days of how many times you have inventory and number of days of receivables you give to the customer. That's the normal receivable period, right? So the inventory came on a particular date. For example, if you have paid cash, and so many times people do this. They pay the cash and then take the inventory, because they pay cash means they can get at a lower price, and then you sell it to the customer. Customer wants a credit period. You give the customer credit period, and that total from the time the inventory came in, from the time the payment is after the time payment coming, that's the operating cycle. But if you have also enjoyed some credit period from your supplier, that you must deduct from that to get the net operating cycle, right? That's the working capital cycle, operating cycle or working capital cycle, right? So working capital cycle, net working capital cycle is what? Is number of days of inventory, how much we kept, number of days of receivables, how much we gave to our customers, minus the number of days of payables we enjoyed from our supplier, right? So this one we will calculate when people are asking for working capital, right? When people are asking for working capital, so we will calculate the working capital for this period, right? So this is the period for which customer will need working capital. So liquidity for him to meet the short-term obligations. So liquidity, normally what happens is that you will look at liquidity whether customer has sufficient cash flow, sufficient deposits, sufficient assets which can be immediately turned to converted into cash, which are like fixed deposits or savings deposits, or like let's say bills or bonds or something like that, what the customer has, which can be turned into cash kind of faster. So that's the liquidity, right? Liquidity. Now, how do you look at the liquidity ratio? Liquidity ratio, very commonly used liquidity ratio is the current ratio, right? You deduct the current assets by current liabilities, you get the current ratio. This basically says is that from the current assets are normally, like what I told you, is kind of a 1 year period. These assets are like, I mean, having a 1 year period. Within 1 year period, these assets now, like, I mean, normally bank balances are immediate, and we presume that the inventory and all can be turned to cash. So receivables and inventory, those are the famous things, and cash and bank balances and all that other financial assets, which forms part of the current assets. Now, current assets, what is the total of current assets? If the current assets are more than current liabilities, then it is this ratio will be 1 and more. So if the ratio is 1 and above, that is good. That means with the current assets, you can meet the current liabilities, right? So your current liabilities, whatever which has to be met during the year, you can meet with the current assets. That's what you mean to say. So more than normal yardstick is that we look at it, okay, whether it is more than one, comfortable. If it's less than 1, we will see other strengths of the business also. So you talk about the quick ratio. Here you don't take the inventory. Inventory is something which, even though we keep it as a current asset, you may not be able to immediately turn it into cash, right? That's for that only we don't take the inventory into quick ratio. So quick ratio is a little more stringent than the current ratio, where you avoid the inventory and calculate and see, right? So normally, quick ratio, when you calculate and see, normally it may not be more than 1, right? If it is more than 1, business is very good, right? Because even if you don't take inventory into account, still the business can meet the liabilities. So in the inventory, that's a subjective term. It can differ business to business. The businesses which are having a high turnover, they will have smaller inventory. So service companies, if you are going and looking at, you don't have any inventory at all, right? IT company, you are going and analyzing accounts of IT company. You don't need to calculate a quick ratio, current ratio. I mean, one ratio is enough because you don't have inventory there. Like, I mean, if it is a kind of a software vendor. But anyway, work in progress will be there. Like, I mean, whatever they have invested in the work in progress, that part will be there, right? Then, so the quick ratio is more stringent than the current ratio, and then that really shows that how is the cash flow of the company, whether they can meet their current liabilities. And then cash ratio, you are taking only the cash, whether with the cash, whether you can cash in short-term investments. So these are, but first one is very quite, first and second normally used. Third one, you don't that often use it, but you should know. So the next ratio, what we are coming to is the solvency ratios. Solvency is what? Whether the business is solvent, right? Business can repay the debts, repay the loans taken. Right? So, okay. So we look at their repayment capacity, short term to long term, with various ratios. Okay. So one other ratio is that debt to asset ratio, right? And normally you take the total debt. Total how much? Totally how much is payable. So which will include both short-term, long-term debt, right? short-term, long-term debt divided by total assets. That shows that how much of your assets are financed by the debt, right? Let us say some business you have a customer who has a total assets of 200 million. Out of that, they have borrowed 100 million. So 100 million borrowed, total debt is 100 million, short term to long term, all that 100 million, divided by total assets are 200 million. So 100 divided by 200, you have 0.5%. So 0.5% is what? 50% of their assets are financed with debt. That's what you understand, right? That's what you understand. So debt to asset ratio is that, I mean, to the asset, how much a percentage is financed by the debt. So for that, we will take both short-term, long-term debt. Long-term debt to asset ratio, also you take only the long-term debt, right? Long-term debt, that will show what is the proportion of assets financed with the long-term debt. So the percentage, I mean, that shows about the long-term. And the other one is the debt to equity, right? Debt to equity. So total debt whereby total shareholders equity. So this shows, compared to the customer's equity investment, how much he has put into the business, compared to that, how much he has borrowed, right? How much he has borrowed. Let us say, like, I mean, a business which has borrowed up to 500 million, they have borrowed. They have something like 1.5 billion they have invested. That's a very good thing. Like, I mean, 500 billion they have total debt, they have borrowed 500 million. But their total shareholder equity is about 1.5 billion. It's about 0.33% or 33% is the total debt. So debt to, so that this shows how much. So the better these ratios, the better solvency, right? They can, I mean, from all this what you are trying to see, from the assets, how they comfortably will meet the liabilities, which are debts, right? So in all these ratios, three ratios what you looked at, all on top you see, all are talking about the debt divided by the, whether it is assets or whether it is shareholders equity, right? The leverage, financial leverage, which is one of the important ratios, is that how much it is levered, right? How much, I mean, what is the reliance of the debt financing? What is the reliance of the debt financing? This is where we said banks are highly leveraged, right? Banks are highly leveraged. If I say my bank has 1.5 trillion in assets, right? If I say my bank, which is 1.5 trillion in assets, so 1.5 trillion in assets. $1.5 trillion in assets. So total equity is 125 million, 125 billion. So that means leverage ratio is what? How much leveraged? Is 1.5 over 125. How much is that? See, my bank is leveraged 12 times. bank is leveraged 12 times. Let us say a business is there. You are looking at a particular business. That business total assets of the business is 1 billion. 1 billion total assets of the business. And let us say they have put a equity of 500 million. Right? So that means how much they are leveraged? We will say 1000 divided by 500. Right? Then you will say 2 times. Still, you will not be, interested in going and lending. Because I mean, okay, you are too much of leverage, right? 50% of your total assets you have borrowed, right? Leverage 2 times. So that you will say that's high. Okay, we are only looking at okay, if you are in a 1 billion business, okay, you put 250 million. Yeah, no, this scenario is okay. This scenario is okay. We will look at it. It's okay. This is all right, fine. Now, if it is more, only the problem, right? If it is more, only the problem. If it is like 250, 750, you are fine. You say you are leveraged 250 million. You want 25%. You will put 75%. Yeah, you are okay with that. But when it's more, some customers come and say that, okay, I'm going to invest in 1 billion. You give us 950 million. Our equity is 50 million. You will not. But the banking business is different, like what I told you. So that's about the leverage ratios. So total assets divided by total shareholders equity. How much is that shareholders equity? So like we have looked at the shareholders equity will include the shareholders, how much of the equity plus all the retained earnings, all that will come into the calculation, right? Okay, interest coverage ratio. That's an important ratio, right? There are many ways of calculating this interest coverage ratio. One of that is this. The purpose of that is that whether from the operating income, operating profit of the business, whether the particular business can pay the interest. So you take earning before interest and taxes, or sometimes we put earning before interest, dividends, accruals, we call it EBITDA, right? Interest, taxes, dividends, accruals also, EBIT, DA, right? EBIT, DA, divided by interest payments, right? So as far as we are concerned, we will look at, this is only interest coverage ratio. We will look at the how their total interest plus capital repayment, whether they will pay from this particular earnings. So there's the other ratio, EBIT, lease payments divided by interest payments and lease payments. Then cash flow coverage ratio, ability to satisfy the interest obligations with the cash flows. These are very seldom used ratios. You don't need to be really bothered about these. But the repayment capacity, of course, the loan repayment ratio, you will look at EBIT divided by interest and capital. All the other commitments to the banks you will take, and that you divide it, you will get the so whether you can take the interest alone, or else you can take the interest plus capital also to look at the repayment capacity. So cash flow to total debt and all that, I mean, these, of course, I mean, not very important. Right. The other ratios for you, the most important, most common ratios when we are taking, this is what we will always look at when we take a set of accounts. What is the gross profit, right? Gross profit. So gross profit divided by total revenue at sales, right? So GP margin, NP margin. Operating profit is operating profit divided by total revenue. So everywhere you will find the denominator total revenue, right? The denominator is the total revenue. You are always relating to the sales figure. The sales figure, what is the gross profit? What is the net profit, right? What is the pre-tax profit? So all that you can calculate related to the sales figure, total revenue, right? Total. So only the numerator will change. Numerator, gross profit, operating profit, net profit, earnings before taxes divided by total revenue will give that particular parameter. So normally you will have the GP margin, NP margin and all that. Industry norm also you will have for you to compare whether this particular company's GP margin and NP margin, whether it is comparable to the industry, whether they are making high profit or low profit or sustainable or not, all that. So based on the returns also, you can look at operating return on assets, operating income. So operating income divided by average total assets is like operating return on assets, right? So how many times the total asset is turned over, right? Turned over. The return on assets is net income divided by total assets. Net income divided by total assets. That's the return on assets. So that it will be a percentage. Higher the percentage is the better. Return on capital, right? Net income divided by interest bearing debt in the total average total equity, right? So the total capital, equity capital plus loan capital, right? So your equity capital and loan capital, how much invested in the business compared to the net income. So net income divided by that gives the return on the capital. Return on equity is what? Your average shareholders equity you should know. You should take the average shareholders equity. Net income divided by that is the ROE. So this is a very popular yardstick, ROE, return on equity, return on capital employed, ROC, return on capital employed, return on equity. These are important parameters to look at a particular business. Even for the business banks in the market, we used to see that what is the ROE, what is the ROC, right? ROA, return on assets, right? So, right. So these are few profitability ratios. Normally, when you are looking at a share in the market, so when you are really doing like, taking decision on a particular share, like, I mean, share as a asset you are going to take, kind of, security you are going to take for your lending, and, guiding a customer in his investment decision. Earning per share is important. So earning per share is normally what is the net income available to common shareholders. In a quoted company accounts, you will find net income available for common shareholders. What is the net income, right? Minority interest and all they will deduct and they will show net income available for common shareholders. The net income available for common shareholders divided normally by the number of shares outstanding. That means number of shares in issue, right? Number of shares, the total shareholder, you total the amount of shares held by the shareholders, number of common shares outstanding. So net income available for common shareholders divided by number of common shares outstanding will give you the earning EPS. We normally call it EPS, earning per share, right? Earning per share is a very important indicator, right? So earning per share, now let us say a company is even your bank or your finance company, you can look at it. What is your company's earning per share for 2020? What is the earning per share? So earning per share, let us say your share is being traded in the market at 100 rupees. Your share is being traded at 100 rupees. So your earning per share, let us say, is 10 rupees. We call your share is trading at 10 multiples. That's what we call it, price to earnings ratio, P ratio. So that means your earnings per share, the price in the market divided by the earning per share. Price in the market is 100 rupees. Your earning per share is 10 rupees. So 100 rupees divided by 10 is equal to P ratio. So this is also very important indicator to look at. Let us say you are investing in shares. Let me show that in the board. Like what I told you, your company, your bank earning per share. Earning per share, you know that is the total earnings divided by total shares. Total shares in issue is your total earning per share. Now let us say for your, this one is that your earning per share is about 10 rupees, right? So the market price of your share is equal to, let us say, 100 rupees, right? Is equal to 100 rupees. Now, how you will look at you look at the P ratio. P ratio is equal to market price divided by earning per share. That's equal to 100 divided by 10. That's equal to 10. Right? We call it multiples, P multiple. So 10 times. P multiple is 10 times. Now, where it comes useful is that then in this, now like if you are working for a bank, the banks normally, what is the P ratio? Common P ratio of the banks. Common P ratio of the banks, let us say, is 5. So in the industry, they will say common P ratio of banks. For example, it is 5, let us say. And if it is 5, your share is overpriced. This is overpriced. Maybe another way of identifying whether share is overpriced or underpriced. This is overpriced. So normally under industry standard, it will be 5 into 10 rupees. It has to be 50 rupees, but it is trading at 100 rupees, so it is overpriced. So we will say, no, don't go and invest here, right? Because it's right at the moment it is overpriced. We are not in that industry now. Now let us say your share is trading at market prices, let's say 30. Market price is 30. If the market price is 30, P multiple is 3 times. So for example, I am telling your market price is not 100, it is 30. Right? P multiple is 3 times. Then we will say, okay, common bank's P ratio is 5. That means 5 into 10, 50, but trading at 30. So there is upward, it can go up to 50. It can go up to 30 rupees, can go up to 50. 30 can go up to 30 can go up to 50. So there can be price appreciation can be there. So value share, this particular share is valuable, right? Can invest. That's how the investors, based on P, when they take a decision, that's the way you take the decision based on this EPS and P. Did you understand? Are you okay? Did you understand or not? Or are you all sleeping?
Understood, sir.
You are finding it very difficult to talk now. Right? So this is about the P ratio. Like this is on the share performance in the market. External, the shares performance are very for that. Now this will be important for us if we are really looking at margin trading, giving facility against shares and all that. Sometimes customers can come and give a share which is really overpriced in the market. Now, how do you understand that the share is overpriced or not? This is one of the techniques. There are many. This is one of the techniques by which you will identify whether the share is overpriced or underpriced. So, okay. The other one is that book value per share. Book value is that, the net assets divided by the number of shares will give the book value, right? So you have the net worth of the business, assets minus liabilities, you have the net worth. The net worth divided by the number of shares will give you the book value of the share, right? That's what we call it, the book value of the share. That also people will look at. That's another way by which, let us say, book value of the share is, in this case, 50 rupees. But share is trading at 100 rupees. You will say share is trading at twice the book value. Share is trading at twice the book value. But in the market, let us say, in this particular industry, shares are like trading at 1.2 or 1.3 of the book value. That means if the share is trading at 100 rupees when the book value is 50 rupees, based on book value, you will say it's overpriced. It's overpriced based on the book value. So you will not, base your decision based on one criteria alone. So there will be many. So book value is one, P ratio is one, right? There are many. The other ratios, like dividend payment ratio, like they also where now people will look at the dividend payments. Now people who are investing look at the dividend payment. The higher the dividend payment, the price of the share will go up, right? So dividend per share is what? Dividend paid to the shares, weighted average number of shareholders outstanding. So that gives the dividend per share, right? So how much dividend paid. So dividend, there are many shares in the market, their profitability is very good, but then the dividend payout ratio is less. So their share price will be less, right? This is another criteria. So now, if you are investing in share market, you know that some of the shares like Nestle's, CTC, that kind of shares, or Caltex lubricants. Now, that kind of shares, you will find that the price is high compared to their book value, compared to their earning per share. All that their price is high because they pay high dividends, right? So the higher the companies which are paying higher dividends attract higher share price. So dividend payout ratio is that dividend paid to the common shareholders and the net income attributable to the common shareholders. So normally what happens is that part of the profit is paid out, balance is put back. We call it plow back. Yeah, put back into the business. That's how you are retaining. That's a retained income, right? Your retained profit. That's the amount which is plowed back into the. So retained profit you maintain in your balance sheet, and then that is going to help the assets to be increased. So plowback ratio, that is how much of profits are put back into the business, right? If the investors, if the equity shareholders, if the owners of the business pull out large amount of profits for their other expenses, for their, because of their lifestyle, their expenses, they draw out, then the business growth will be limited because the profit is not put back into the business to grow. So plowback ratio also you can calculate by way of 1 minus dividend payout ratio. So if the dividend payout ratio to the customers are like, out of 100 rupee they earn, 10 rupee they pay as dividend, 90 rupees they plow back. That means dividend payout ratio is 10%, means 90% they put back. So 1 minus dividend payout ratio is the plowback ratio, right? The proportion of earnings retained in the company for the growth of the company. That's the plowback ratio. All right. Are you all back?
Yes, sir.
Right. Now, can you look at this particular example? Just we will do past papers on the areas which is relevant to the exam. One or two past papers we can look at. This particular shareholder related this one, just have a look at it and then tell me the answer. Calculate the book value, P ratio, dividend per share, dividend payout, and plowback ratio. Right? Can you calculate and tell me? Yes, do you look at? Go ahead. So book value is what? Book value is total book value is 100 million, right? Book value per share is equal to total book value is let's say 100 million, and you have number of shares 100 million. So you have a book value per share is $1, right? It's a $1 book value per share. Then P ratio is what? You need to find out the earning per share. What is the earning per share? Earning per share is that your net earnings is 30 and your number of shares is 100. Are you right? Okay. About 0.33. Right. Earning per share. And P ratio will be market value per share divided by earning per share is equal to your market value per share is that 500 million divided by 100 million, isn't it? Your market value is that your market value per share is equal to 500 divided by 100 million is equal to $5 is equal to Pi divided by 0.33. Is it correct? Is this correct? Yes. So your PV price earning ratio is market value per share divided by earning per share, pi divided by 0.33. And then what is the dividend payout ratio? Dividend per share. Your dividend per share is that dividend per share is equal to paying 12 million divided by 100 million, right? 12 divided by 100 million. Yes. So C multiple 15 times, and you have 12 million divided by 100 million. Point 12, and then you have clawback ratio is equal to how much? 1 minus .12 is equal to 88. That means 88% is put back into the business. Are you all okay? Are you all okay? Are you all okay?
Yes, sir.
Can you see the screen? Can you see the presentation?
No, sir.
You can't see.
No, sir.
Can you see now?
No, sir, not yet.
Not yet, is it? Can you see the screen now? Still not.
Still not, sir.
කාලින්ග අර ස්ටාර්ට් එක පොඩ්ඩක් එන්න කියන්න මට මේක දාගන්න මේ ප්‍රසන්ටේෂන් එක. presentation again. Oh. Thank you, sir. Can you all see now?
Yes, sir.
Right. Thank you.
Yes, sir.
Right. Okay. Little bit of technology glitch. Right. Now, so ratio analysis. These are the ratios we will be looking at. Like what I told you, we will look at all these liquidity, their performance, the turnover. Right. So these ratios, we will again do a question paper also and try to understand. So in addition to ratio analysis, the analyst should describe the company. I mean, what is the line of business, products, what are the major suppliers, what are the industry information, major factors and influences. That also analysts will have to look at. So effective use of ratios, basically over a period of time, what are the changes, how this has happened compared with the other companies in the same line of business, same industry norm, all that will have to be taken into account. Also, like, I mean, the ratios might behave in a different way when it comes to major events which is taking place in the businesses, like, I mean, you know, whether they are merging and then whether divesting, like, I mean, any accounting changes happening, right? Okay, product mix has been changed. Even during that time, ratio analysis can change. So that, I mean, standard way of analyzing should not be there. It depends on the company's particular time in which it has been done also. So the other aspects also should be taken into account in your analysis. That's what we mean to say. Right. That's about the financial analysis, which we will do some questions for you to understand more. Right. Now we will go into the next area now. The next area, the paper, I will try to do one paper next time, right? After finishing this particular tute presentation, we will look at a paper. I will bring a paper in advance. I will keep the staff informed, and then we will upload the question paper, and then we will do a paper, right? That probably the next class or the class after next, we will do the paper, right? Okay. Classification of loans and advances. So you should understand, what do you mean by classification? What are the on-balance sheet and off-balance sheet assets which are subject to classification, right? So the on-balance sheet items, we normally say, what are the things which will come to the balance sheet? To the bank, the bank's balance sheet. Bank's balance sheet, you will find the things which we have funded, right? The balance sheet, you will find all the assets, means whatever loans which we have given, which we have funded. Those are the funded, I mean, those are the on-balance sheet items. Off-balance sheet items are things like which will not come to the balance sheet, but still the outstanding will be the bank as a liability on that, right? Bank as the liability on that. For example, if it is a term loan, block loan, packing credit, pledge loan, revolving loan, whatever bills financed, bills discounted, high purchase loans, lease, trust receipt loan, owning advances, credit card facilities given, reverse repurchase facilities, debt instrument, all these things are funded. Bank has parted with the funds for the customer. So that is an asset to the bank which will be on the balance sheet, right, which are recoverable. But there are other things like, if you are given a guarantee in the branch, if you are given a guarantee, that is not in the balance sheet. But the guarantee, the moment it is claimed, it can become a funded outstanding. When it's claimed, we'll have to pay. So that is, that's a contingent liability. So if you take LC, you are opening a letter of credit for import of goods. So you have opened LCs for a customer. The customer LCs have been opened, but then we haven't parted with the funds. So it is not on the balance sheet. But what happens is that if the exporter taking the LC and export the goods, and according to the LC, he has sent the documents. So documents have arrived. And here what happens, once the documents have arrived, documents are in order, we will have to release to the customer. So the moment we release to the customer, that becomes a funded facility, because we need to settle the supply overseas based on the LC terms. So the moment we settle, we'll create a loan to the customer, right? If the customer has funds, okay, no problem. He says that, you can debit my account. But otherwise, we pay the bill and then create a loan. So then it becomes funded. So these are called off-balance sheet credit facilities, which has the quality of becoming a funded facility somewhere down the line. So the guarantee, bonds, warranties, letter of credit, acceptances, and all these kind of things, which are in the nature of turning into a funded facility, are termed as off-balance sheet items, for our analysis. So borrowers can be individuals or single companies or government, or like a public corporation, statutory bodies, firms or associations of persons or any other institution. This according to the central bank's definition, right? Those are on-balance sheet, off-balance sheet items, and the definition of borrowers.
Yes, sir.
Yeah, go ahead.
What is mean by warranties?
Warranties are kind of, like, I mean, in the literal term, what happens is that, if you're buying a product, you have a warranty certificate. The warranty certificate is that within 1 year period, if something happens, the company will repair the good free of charge. That's a warranty, no? When it comes to a normal product. That's what you will understand. So if a product is there and there's a warranty, company will do it. So like that in a loan agreement, any of the agreements with the customers also, we may have issued warranties, right? A warranty is if there is a problem, like, I mean, if the bank has not complied with the condition, bank becomes liable for that, right? Bank becomes liable to the let us say we have taken a loan from IFC, for example. We have taken a loan from IFC. From then we have there is a warranty term, right? Okay, so you cannot this particular loan you need to lend to only SME. You cannot lend to any other corporates above say 1 billion turnover. But we have gone in lent. That is, we have violated that, and we become liable. And we become liable to IFC. So the warranty asset, it can turn to a liability to the company based on our activity, right? So for you to easily understand only, I was telling about the product warranty. Something like that here also, when we are enjoying this, something from somebody, and if you make a mistake, bank becomes liable for that, right? In the sense, if you have violated the warranty. LC, guarantee, bonds also, guarantees and bonds and all that. I mean, if we have given a bond and then if there is a violation, we are becoming liable for that. Okay.
Okay, sir. Thank you.
Performing loans shall mean all the credit facilities other than the non-performing. This is the central bank's definition. It says performing loans and advances shall mean all the credit facilities other than the non-performing loans. Then you should understand what is non-performing loans. Whatever which is not non-performing loans are the performing loans. Okay. So then central bank says non-performing loans shall mean bad and doubtful debts coming with the meaning described below. So their definition is simple. Whatever which is not NPL, which is performing. So what is NPL? NPL, they have given series of definitions. Okay. So any facility which is fully covered and enforceable, fully covered by cash, can be taken off from this definition, which is not NPA, even though it is not paid or whatever. Anytime it can be settled with a cash cover, but you have cash backed facility. Other than that, others can come under the purview of non-performing advance, definition of NPL. So then let's see what is NPL then. So NPL, basically any overdrafts which is in excess of the limit continuously for over 90 days, right? You have given a limit to an overdraft, and then the particular overdraft remains in excess of the particular limit for more than 90 days. That becomes a non-performing advance, right? When it comes to overdraft. Credit facilities, if it is monthly installments, if the installments are paid monthly, then 3 consecutive installments are not paid With the third installment, that becomes a non-performing advance. Right? If it is a quarterly repayment or half-yearly repayment, from the point of due date, you take the due date. From that point, how many days you will calculate. If it is 90 days, if it is past 90 days from the due date, then it becomes a non-performing advance. Even if it's a half-yearly, there are we sometimes structure facilities for quarterly payment, half-yearly payments also. So if it is a half-yearly payment also, after the due date, we look at for 90 days. If 90 days, if it is not paid, then it becomes a non-performing advance. So even if it is a bullet payment, one payment credit facility we give, so one payment it has to be paid. Even if it is one payment, from the due date, if it is 90 days overdue, that becomes a 98th day, it becomes non-performing advance, NPA. Credit card also, if the period which is not paid, right, from the due date. Now credit card we give a minimum payment about 5%, minimum payment, 5% minimum payment paid is okay. Credit card is a killer basically. If you are using credit card, it will be a killer, like if we are only paying the minimum and continuing, because for the balance all the amounts you will be paying very high interest rate. So credit card, it will not be a non-performing if the minimum payment is made. If the minimum payment also not made, which is in arrears for 90 days from the due date, then for credit card also that becomes a non-performing advances. That is basically is about non-performing advance. I mean, how do you look at a non-performing advance, performing advance, and non-performing advance? So this is the very reason your bank also, you all will be following up with the customer with one installment, two installment. You will run behind the customer so that avoid the particular advance getting into the non-performing. If an advance is going into a non-performing advance, that is where the problem, because that stops performing for you. That stops giving profit for you, because then the interest will be suspended. Interest will not be taken into P&L. Right? Unless that becomes a performing, interest will not be taken into P&L. Right? Interest will be suspended. So in addition to the classification requirements for NPL, bank shall classify PL as NPL where full recoverability in accordance with the agreed terms is in doubt due to circumstances affecting the repayment capacity. So there are banks which have prudent practices, in the sense, even I mean, this is the common, this is the given definition we let fall in line with. This is the minimum requirement. This is the minimum requirement. But banks can be prudent. Bank can provide the moment the bank thinks that this may become a problematic advance, may not be paid, or there will be delinquency which we are expecting in future. If you have any such expectation, better to go and provide it, make it an NPL. Right? So that's what is, I mean, banks will have to exercise their judgment. For example, let us say you have now, the other day I come across a case where we have lent a loan, customer has taken for a poultry farming. So the poultry farming where they are going to put the land with all the fixtures and everything. Land is mortgage, and the fixtures, everything which was financed, and purchase of birds and all that kind of thing, working capital, all that has been financed. What happens is that the customer was not able to commence the business because the locals in the area, they started revolting, and it became a problem of continuity of the business. They can't commence the business and continue because of the local agitation, which is supported by the local authorities also. Then it was an issue. So it is actually from the time it is given, then after that it is going to be a problem. So you go and provide it, right? You go and classify it. Go and classify it because we know that time is going to be non-performing, right? Go and classify it. So don't wait till this 90-day or all that because better classify because that's nature. It's not going to be paid. So new credit facility shall mean any credit facility granted to the borrower with the involvement of cash or fund movements. So facility granted for the capitalization of the accrued or unpaid interest or to convert an overdraft to a term loan shall not be considered as a new credit facility. Now, like many a times we try to this is kind of greening your portfolio. You go and give a loan and then observe another bad loan. That is not to be considered as a new loan, right? Facility granted for the capitalization of the accrued and unpaid interest, but convert an overdraft to a term loan, it is not considered as a new credit facility. That should not be. So this definition is important for you. It's very important because under normal circumstances, advance overdraft or whatever, you will go by strictly go by this particular 90 days from the date it is owed you and all that. Now, the same treatment you cannot give for a restructured loan, where you have restructured by converting overdraft, converting a loan and interest into another term loan. Reschedulement of the time calculation is important. So when you are doing the reschedulement is that what is scheduled, which is not working, you are trying to go and again do a reschedule the payment. That's what reschedulement. So when the reschedulement occurs before a credit facility is classified as NPL, right? Now let us say in your performing advances, customer has not paid 80 days. So from the due date, he has not paid for 80 days. Now we are going and rescheduling, right? So it's a performing advance. We are going and rescheduling, right? Giving another new advance with capital and interest all together. We are giving a new loan, and then rescheduling it for a longer period, which we are doing. The rescheduled credit facility shall be classified as non-performing when in aggregate the period of time the credit facility was in arrears. That means now at the 80th day we went and rescheduled. Now let us say that after rescheduling the due date has come. So from the due date, let us say now 20 days gone. 20 days gone. Now before rescheduling 80 days outstanding. After rescheduling now 20 days gone. That means 100 days gone. So 90th day it becomes non-performing. That means from the day it is rescheduled, from the due date of that, if the customer has failed to pay even for 10 days, if he has not paid for 10 days, and then it becomes 9PA. So you don't wait after rescheduling from the first payment date, you don't wait for 90 days, but you calculate with the previous period also, right? So when rescheduling occurs before a credit period is classified as NPL, the rescheduled credit facility shall be classified as non-performing when in aggregate the period of time the credit facility was in arrears before rescheduling and after rescheduling exceeds the time period specified in the above direction. Hope you understand that. Keep that in mind, because we will think that, okay, a new loan given from the time it has become due, 90 days we can give. You can't give like that, right? So you need to calculate, because this is when it was overdue for 80 days only we went and rescheduled. Now, this is one other important provision in the central bank's guidelines. Say you have given a composite facility which involves many credits, overdraft loans, import demand loan, packing credit loan, all that. I mean, you have pre-shipment loan, but so you have so many advances given to the customer. Now, out of many facilities given to the customer, let us say overdrafts are okay, which is running within the limit, no problem. But few ideals are not paid, right? Few import demand loans are not paid. Let us say such ideals which are not paid in total is more than 30% of the total credit facilities extended to the customer. Then the customer will be classified as non-performing customer, and all the facilities will have to be classified. Right? All the facilities will have to be classified, not only those ideals. Right? If it is less than 30% of the total advances, no problem. If it is more than, if it exceeds that 30% of the total advances, then the total, all the other performing also will be put under non-performing. Right? That's a very important provision of central bank. Right? This happens because some customers were in the habit of defaulting somewhere, and whereas enjoying working capital facilities with some other facilities, like overdraft, they keep it within the limit and then keep on depositing, taking out and all that, while not paying the loans. Right? So due to that only, central bank has said, if in aggregate, if 30% of the facilities granted to the customer, if 30% or more is becoming non-performing, then the entire facilities given to the customer becomes non-performing. Any questions there? Any questions? Anything you didn't understand?
Sir, can you repeat the classification of multiple credit facilities granted to a single borrower again?
I didn't get you. Single borrower?
The last section.
The last one, what I told you.
Yeah.
Yeah. It is for a single borrower. It is for a single borrower. If it is, you would have given many facilities to the customer. Now, some corporate customers, you will have many facilities given. Now, and then even the group will have to be taken into account. Even in the group, if you take the group or single customer, single entity, or individual or entity or group facilities what you are given, out of that, if 30% of the facilities are becoming non-performing, then all the 100% also will have to be classified as non-performing. That is the idea. That is the idea. Now, for it can be an individual who is enjoying about 10 loans and about 2 ODs and then 10 other loans and all that. But out of the total, there is the 30% of the value by way of value. This by way of value you will look at. For example, you have given 100 million facilities to somebody, or somebody, an individual, a group, or one entity, or like in that, if it is the non-performing advances more than 30 million of facilities are not performing, or like, I mean, they have not paid for more than 90 days, then when you will classify those, while you are classifying those, as it is more than 30% of the total facilities enjoyed by the company, group, or individual, the entire 100 million will have to become non-performing advance. That's the meaning. Is it okay?
Yes, sir.
Thank you. Okay, out of NPA, what are the classifications are there? Out of NPA, as per the central bank's guidelines. These are the central bank's guidelines out of NPA, right? So whatever which is overdue for 90 days, you know that from the due date, it becomes NPA. In the NPA period, so after 90 days, what will happen, right? How do you classify? What you are supposed to do, right? So if the overdrafts are remaining excess above the limit for about 90 days, but within 180 days, right? 180 days. So these are all called special mention SMA, right? Special mention accounts. The credit facility is, you know, like, I mean, if it is monthly installment, 3 installments to 6 installments, right? The credit cards more stringent. Credit cards more stringent. Credit card under the SMA from 90 days to 120 days, another 30 days only. Others we are looking at another 3 months, but then here for credit cards only 30 days. Those will be in the special mention, right? The other irregular facility, in the sense, I mean, the periods are different. The payment in arrears for 90 days, but not more than more but less than 180 days. More than 90 days, but less than 180 days. Those are also SMA category. Those we call SMA. When it comes to more than 180 days, call it substandard credit facilities. So for the substandard credit facilities, the definition is that is between 6 months to 1 year, right? So more than 6 months, but less than 1 year. If it's overdraft, if it is monthly installments, 6 installments to 12 installments. If 6 more than the overdue is more than 6 installments, but less than 12 installments. And credit cards is basically 4 months to 6 months, right? Basically, it's half of what other credit facilities. If it is more than 180 days, more than 120 days, but less than 180 days, less than 6 months, more than 4 months, less than 6 months, that is substandard, right? Other credit facilities basically, which are like coming 3 months or 6 months, like the repayment, I mean, the payment in arrears are more than 180 days, less than 360 days, which are called substandard credit facilities, right? Those are called substandard. So we looked at special mention accounts, and we looked at substandard. Then the doubtful. The doubtful credit facilities are basically overdraft means which is above the limit for more than 360 days, right? More than 360 days above the limit, which is called doubtful, right? SMA, substandard, and doubtful. Now it is doubtful. So like that, if it is monthly installments, more than 12 installments overdue, right? Up to 18 installments, which is called doubtful. It's doubtful. So credit cards basically 6 months, more than 6 months, but less than 240 days, right? So 8 months, less than 8 months means credit cards, those are doubtful. So called doubtful. Other credit facilities basically 365, more than 360 days, less than 540 days is those are called doubtful. Then comes the loss. So what do we call loss? So the sanction period, the overdrafts above the limit approved, which is remaining above the limit for more than 540 days, means it is called a loss, right? Other credit facility 18 installments or more, which is not paid, which is a loss. Right? Credit cards more than 240 days to be categorized as loss, right? Other facilities. So that means loss means what? Your credit, capital, interest, both you will have to write off. Right? Payments are in arrears for finance, say 40 days or more. Write off in the sense you will have to fully provide. I don't say write off, you will have to fully provide. Right. That is about your classification of your loans based on the period. Yes.
Excuse me, sir.
Yes.
Sir, during this pandemic, does that central bank issued any direction to amend those classification?
Yeah. What happened? The central bank has given moratorium period. They have given moratorium period. That means they have said the you give period now. The first moratorium first time they gave in 2020 during April period. I mean, like April to 6 months period up to September 2020. They gave a moratorium period. During that time, all the loans which are, the customer don't have to pay the capital interest has to be paid. Capital you don't have to pay. Even if the capital is not paid, you are not going to classify that. So that moratorium period they gave first time. Then again, after the second wave which came, also central bank said you can give moratorium period up to March. Let give moratorium period up to March, starting from October, November. You give another 3 months of moratorium period up to March. So the customers who are not paying, like for some customers, had to be given both interest and capital. Some customers we were giving only the capital moratorium, so that capital don't have to pay, interest they will have to pay. And these tourism industry, the hotels and all that, moratorium period extended up to September next year, this year. Until this September, they don't have to pay the capital. So this is given specially for the COVID impact, so that for during that period, these classification criteria will not take place. Only after that. Okay. So all of that's what I had been telling. These so moratorium has been given so that, I mean, the quality of our credit, quality of our loan book, we will be able to see only after the moratorium period is over. What is the quality like? I mean, then if the customers are not paid, and if you have to classify that. Now that, of course, customer don't have to pay, whatever we have given the moratorium period, customer don't have to pay. So we are waiting for the period to be ended until March. But if the customer doesn't pay after that, now whether customer will have sufficient cash flow by that time to meet the payments, so whether he will default and all that, only after that we will see. That is the very reason in the market also the investors are also waiting. You also can see the share prices of banks are not going up in the market, irrespective of the fact that rest of the companies are going up and all that. Bank share prices are not going up because people are also scared what's going to happen to the bank balance sheets, right, after the moratorium period. So that's one of the reasons also, like people are watching and seeing how the banks are going to perform, right? Whether they will have higher amount of non-performing advances, whether that will bring down the profitability, whether that will increase the NPA in performance of the banks, and all that. I mean, the people are waiting to see, right? Okay.
So as you said, there is no any amendment for classification. It's mean right now that NPA is classifying that 3 to 6 months.
Yes.
So that there is no any tenor amendment done by that central bank, is it?
Central bank, what they did was I mean, there are many categories. Some of the categories were for them tenor amendment was done. Like, I mean, you extend it by 3 months, you extend it by 6 months. So repayment capacity period also extended. That means the customer will not pay the capital for these particular, let us say 6 months, and the capital repayment will start from after 6 months, from let us say April of this month, of this year. So then what happens is that then by the equal amount, I mean, if the loan is to be paid off in January 2022, it will be paid off only in June 2022. By 6 months, it is extended. Some loans were done that way. Some loans were like given moratorium period given, the period not extended, but the capital quantum is increased for the balance period. Capital quantum is increased. So there are many ways it was done. Some loans were like, I mean, you know, capital and interest also. Customer doesn't have to pay; it has to be paid only. And then interest you will have to give another loan. Together, whatever interest to be paid, you total it up and give another interest-free loan or something. Interest-free loan and capital. So there were many, I mean, depending on the industry, depending on this one, many options were given in the moratorium guideline. There are so many guidelines given by central bank over a period of this April to December. So much of guidelines, so much of FAQ, you know, question answers. So many things are there. Still, you know. So a lot of ambiguities are also there in some areas. So which the banks are really, I mean, working with central bank to sort out. So that's why I didn't really take those into this account, because that's a one-off incident, one-off thing which has taken place in the market. But the long-standing policies, of course, the classification policies and then, you know, provisioning policies and all will be the same. But only for COVID, there are some changes which has taken place. These changes, of course, probably part of it will be corrected by April, and part of it, the loans which are given to, advances which are given to tourism sector, will have to, you know, that will start being paid from October.
Sir, for those moratorium given loan, can we able to calculate any accrual interest for this thing, for a profit kind of thing?
See, now moratorium loans interest what we are recovering. Now there are major part of the loans where interest can be recovered. So those interests are taken to P&L, no problem. Those interests what we are recovering is taken to P&L, no problem. Even otherwise, those interests can be taken to P&L because that's under moratorium. I mean, that's the exemption given by central bank, because it's not a due, no, like, I mean, in the sense the loan is going to be due only after the moratorium period. So that interest moratorium given also, those interests can be taken to P&L, no problem. So moratorium is a freeze on these particular regulations. But after the moratorium period, then these will be 90 days. Are you okay?
Yes, sir. Thank you very much.
Okay, welcome. So reclassification of NPL as a performing loan, banks can reclassify, right? If interest and principal in arrears are paid by the borrower, like let us say there are 3 installments overdue, 3 installments, so customer is paying off all the 3 installments. It can be reclassified, right? Reclassified. So reclassification of rescheduled NPLs basically They are the NPL accounts which have been subjected to rescheduling, whether in respect of principal installment or interest amount, would be eligible to be upgraded to PLA performing loan category only after the specified periods in respect of the following category. So there is a category given by central bank. Only after that category you will take those reclassified or the rescheduled loans you will reclassify into performing. So that category is there. So if the loan was in SMA special mention category when it was rescheduled, right? So from the day it was rescheduled, 90 days, you will have to wait for 90 days. After 90 days only, it can be taken to performing loans, right? If it is in the SMA. If the loan was in substandard and we went and rescheduled that, then you will have to wait for 180 days. You can't take to PL because you reschedule, you can't take to performing. You will have to wait for 180 days or 6 months time. So if it was in loss category and if you had done that, you will have to wait for 1 year to take it to PL. Just because you went and reschedule, it doesn't mean you can take to performing advances, right? So this has to be followed up now. Like, I mean, let us say facility which, yeah, go ahead. There's a general provision requirement of 1%. This I hope has been brought down to about 0.5%. What is the general provision now? One of you tell. One of you tell. So you do not know. One of you, your mic is on and you are talking. One other student, your mic is on, you are taking personal call, careful. Okay. 1% the general provision. If there's any changes, I will tell you. Right. So normally central bank would like to have on the total performing loans, outstanding on balance sheet performing loans, central bank would like to have a general provision. That's a 1%. So you keep a provision. Special provisions is other ones. You are creating special provisions on the loans which are going to be, in the SMA substandard, loss categories. So the specific provision requirements, the central bank requirements are, you don't provide when it is SMA, but if it is substandard. For credit card, you will have to provide 25% of the outstanding, right? 25%. Others, 20%. If it is doubtful, if we looked at 4 categories: SMA, substandard, doubtful, and loss. So SMA you are not going to provide, but if it is substandard, the credit card 25% and then others 20. If it is doubtful, 50% provision is needed. If it is loss, 100% provision is needed. Provision means what? You will have to create a provision thinking that you may not be able to, you may not be recovering the particular loan, right? So you'll have to make a provision. So provision will take the money out of your profit and loss account, right? So when you are providing on any loan, which is in the category of substandard or doubtful or loss category, then your profit will be reduced by that amount. That is the problem with the NPA for a financial institution, right? So whether total 100%, if it is loss category more than 18 months alone, whether you are going to have total 100% in provision, that of course there is another provision there for you, right? So this is where you will look at your asset you have taken as security, right? Immovable property. Now if you have taken other assets like mortgage over stocks and book debts and guarantees and all that, that doesn't come here. You can't have a haircut there. You can't reduce the value of that here. But the immovable properties, if you have taken a security, and we can take a percentage of the forced sale value, right? So the immovable properties also, which can be freehold property or leasehold property, right? So at the first time providing, when you're doing the provision, so you can have 75% of the freehold property. You can take the 75% of the sale value of the property, and for example, let us say 100 million loan we have given, and we have a property mortgage of 100 million, right? 100 million you have given a loan, and then you have a property mortgage of 100 million. Okay, so the for sale value of the property also, let us say 100 million. That means you can, while doing the provision, you will make a provision of 25 million. 75 million you have these particular, it's a freehold property, means 75 million you can reduce from your provision amount, right? This is why you all are looking at banks are looking at property mortgages. Property mortgages brings down the risk of kind of making provisions. If the loan is not paid, or if it becomes non-performing, this is the cushion what you are getting from the immobile properties what you are taking as security. So period in the loss section, right? If the period in the loss section is less than 12 months, right? In the loss section, it has gone after 18 months, it has gone into loss. If it is less than 12 months in the loss section, 75% you will take into account. Then progressively, if it is more than 12, right, but less than 24, 60%. If more than 24, less than 36 months, 50%. More than 36, but less than 48 months, 40%. If it is more than 48 months in the loss section, right, a particular loan is in the loss section, right, more than 48 months. To the loss itself, it takes about 18 months. And then after that, the loan is there for 48 months after that also in the loss section. That means you will not give any value to the property also. You will have to fully provide, right? Fully provide. This is what that means. So freehold property and leasehold property, these are percentages which are taken into account in doing the provisioning, right? So if it is a leasehold property, you have a lot of properties which are kind of leasehold. Now 30-year lease, 99-year lease, right? And someone has taken over a property where it is a 99-year lease, and which has passed 50 years. So balance you have about 49 years of lease. So leasehold properties, of course, the amount of deduction you will make is lesser compared to freehold property. Freehold properties, like, for lifetime, that is the ownership is there, right? So here, as per central bank's regulations, if a particular loan advance is there in the loss section for more than 4 years, right? For more than 4 years, the property value will not be taken into account at all. So then, I mean, up to 12 months in the loss section, up to 12 to 24, up to 24 to 36, that the percentage has been given. So this is how the value of the freehold or leasehold property will bring down the amount of amount you have to provide for the loan. Okay, any questions here? Any questions on considering the property value in making provisions? Anything you didn't understand? Are you okay?
So what is haircut provision?
Yeah, this is the haircut. I mean, you keep on, reducing, this percentage. That's what you call it, haircut provision. Now, like, I mean, when you are doing the, you see, when you are lending, you are taking 100% for sale value, right? You are taking 100% for sale value. Let us say you are going for a mortgage, property mortgage for 100 million, right? 100% you are taking, you are considering. But when you are going for provisioning, when you are asked to provide, right, this provisioning rule here, what do you do? Right, provisioning requirement is here. Now, like, I mean, you are to do a, say, particular loan what you have given. When it comes to substandard, right, you have to provide for 20%. While you are doing the provisioning for 20%, right, you have to make the provisioning for 20%. How much of asset you can consider, right? For example, you have given a loan for 100 million. Now, 100 million, the first time when you are provisioning, you will have in this, you see that 75% at the first time provisioning, you have 75% you can consider. That means 100 million you are to provide, of the 20% you have to provide. But then you can go in 100 million, you will reduce this 75 million. When you reduce 75 million, you have 25 million, right? Balance 25 million. Of that 25 million, you will go and provide 20%, right? So there's a provision. So then, so progressively what will happen is that,
So based on the valuation report.
Yeah, based on the valuation.
Sorry, sir. So based on the valuation report, we are doing this thing. So is there any validity period for
Yeah, valuation.
Valuation report?
Yeah, valuation report, as per the central bank regulations, 3 years it is valid. Every 3 years, they say you must review it. Especially when it comes to this NPA and all that, for you to take this into account, if it is not reviewed in 3 years, its validity, they say 3 years. If it is not reviewed in 3 years, they say you need to 100%, you can't take the percentage, you need to 100% you'll have to provide. That's the central bank's rule. They say, for example, let us say now, say in the loss section, this particular advance of 100 million in the loss section, which is there for more than 24 months, right? Less than 36 months, it is there. So that means you can consider 50%. That means 50 million you can consider, and then for the 50 million only you will have to fully provide. 50 million you will have to provide. But if the valuation is more than 3 years, central bank can say, no, your valuation is more than 3 years, so that you will let 100 million provide. Right?
So it is categorized residential property and commercial property.
Yeah.
Valuation.
Yeah, both. Anyway, central bank's guideline is, as far as I can remember, it is 3 years. They say every 3 years you must review. In the sense, performing, you will not have a problem. Non-performing, when you go into that, when you're providing, they will say, okay, you have haircut, you have used 50% here. Okay, what is your valuation? Valuation, they will look, they can look at it and say they can disqualify that. They can say, no, you will have to provide. It's not. So that is a requirement by them that I mean, the property should be, revalued or reviewed. Are you clear?
Yes, it is clear. Thank you.
Right. Okay. So that is how you are creating. You have to make the provisions for the facilities. That's this is the way you will create the provisions. So now, normally what happens is that, like what I told you, banks, some of the financial institutions will have their own, provisioning policy, which will be more prudent than this also. This is like, this is the minimum. You need to have this minimum. You must have. If you don't have this, then you are violating. But some of the banks now like thinking that time, okay, more than 1 year they will fully provide. More than one year overdue, okay, fully provide. So, like, I mean, it depends. I mean, you have to comply with the minimum, but anything more stringent you want to have, that depends on the particular financial institution's culture and their appetite and all that. Based on that, they will do. Right. Any question here on the provisioning? This is important for you. This is what haircut rule anyway. Now, how you are, reducing the freehold property or leasehold properties, percentages in your provisioning is what the haircut rule.
So what about gold back loan? It's mean pawning kind of thing.
Pawning also will come into this only, but then normally what happens is that pawning advances are, you are auctioning, right? It doesn't wait this long. Okay, 3 installments not paid, you give a notice and then it is auction, because you auction and recover. So it doesn't come into this. You don't pawning advance not paid for 1 year, you won't keep. You just auction the property and take it. The moment it goes into SMA itself, it is taken and auctioned. Okay.
Okay, sir.
So the any property we take as security for this, the valuation, professional valuation is necessary, right? So the regulation is that for facilities above 5 million or 0.1% of the capital of the bank, right? Whichever is less. That means 5 million, right? For 5 million, I mean, if the capital of the bank is, 0.1% comes less than 5 million, yes, that amount. For that, any facilities for that amount or more, a professional external valuation is necessary, right? You need to have a valuation for fixed asset. If you are going on a fixed asset, if you are taking a fixed asset as a security, right? So period of valuation report. Now, home loans granted, this is the answer for your question. Home loans granted against residential property occupied by the borrower, it cannot be more than 4 years. Others, 3 years. I told you 3 years, but home loans, basically, I mean, if it is occupied by the borrower. Now, many a time home loans taken and then if it is rented out or whatever, that also will be 3 years only. Home loans taken and then occupied by the borrower, right? The person who has taken the loan, minimum period 4 years, right? Valuation. Now, if it is any other commercial and everything, is 3 years. So every 3 years it has to be renewed. So now taking valuation for practical purposes, you see, going and taking a valuation report is, there's a cost every 3 years. If you go and charge the customer valuation report also, customer also will become angry. So we need to have a kind of arrangement with the valuer. You review that and give, right? Now, whether there's any changes, right? All that, I mean, that kind of thing at a lower cost or whatever, we'll have to manage it that way. But central bank wants that it has been reviewed.
Excuse me, sir.
Yeah,
For
go
the
ahead.
revaluation purpose, we can't give the valuation request for the same valuer, no? It should be done by another valuer, no?
It doesn't, I mean, it doesn't mean that you can't go to the same valuer. They don't say you can't go to the same valuer. They only say that, I mean, it should have been now, like, for example, let us say a particular property now, like, I mean, let's say due to something, a roadway has come or a flyover which has come or a factory nearby come or the value of that particular property has changed, right? So the same value I can say that now, I mean, earlier 3 years back, this was the value. Now, due to these factors, the value of the property has gone down in this particular place. Let us say it's a residential property. As a residential property, value is low. So same value I can do. It doesn't say that, I mean, same value I can't do. You need to go for another value. But the period is important. Okay?
Okay, sir.
So for less than 5 million, independent senior officer of the bank can do the valuation, right? So for that, of course, not more than 2 years. Now, like, I mean, you are in the credit department, you are getting, we can ask a senior officer from another department of the bank to look at it and provide a value. That's for less than 5 million. That's acceptable. But that has to be revalued. I mean, valuation has to be reviewed after 2 years. So maximum period is 2 years only. So the valuer needs to be a chartered valuation, right? Valuation surveyor, or there are some qualifications given as per the central bank. Some qualifications are there for a valuer. Not that everybody can go and do a valuation. A chartered valuer, surveyor, or should be a fellow of the Institute of Valuers of Sri Lanka with 5 years experience. So a graduate member of valuers of Institute of Valuers of Sri Lanka with 10 years of experience, or else an associate member of IVSL with 20 years of experience. This is the minimum requirement for a valuer, right? A chartered valuation. External independent valuer means they must have minimum this qualification. So what is the value you will take from the securities? This is about from different securities, what is the value you will take? If the mortgage, other than the primary mortgage one, now like customers, sometimes for customers we take a secondary mortgage one, tertiary mortgage one, quaternary mortgage one, fifth mortgage one, all those things are there. So if a mortgage you have, other than the PMB, primary mortgage one, like realizable value will be if other mortgages are also with the same bank, the realizable value you will take, right? Total. Normally, if primary mortgage bond is there with somebody else, then there is an issue, right? When it comes to realizable value. Realizable value for the purpose of this haircut, there is a problem. Secondary mortgage will not be allowed, right? Primary mortgage and other mortgages are there means okay. With the bank, it's okay. Then title deed, sometimes customers come in say that, I mean, here is my deed. Many of the money lenders do this. Come and keep the deed, right? They take the deed of people and then keep it with them. Or take an undertaking to mortgage, all that. So those have no value. Actually, as a realizable value, there is no value. There is zero value, basically. It's just a comfort only. Life insurance policies means you take 90% of the surrender value. And look at the 90% of the surrender value of the realizable value. Gold is market value, subject to insurance. Quoted shares, 90% of the market value. So these are central bank quoted figures. Trading suspended in, if trading suspended in audited accounts available, net realizable tangible asset value can be taken for the shares. Now, unquoted shares, you don't have a market value, right? If it's unquoted, shares as a security, is not traded in the market, so that openly you can't see this is the value. For them, 75% of the net tangible asset value, you take that tangible asset value certified by the company auditors, right? Of the 75% can be taken. Mortgage over plant, machinery, equipment, many of these things we take as security. Based on valuation report or net book value, right? You depreciate over a period of 20%. Now, this is straight line. 20% depreciation of machinery is a inland revenue accepted percentage. They normally say that over a period of 5 years, machinery will be depreciated, right? Motor vehicles in 4 years straight line depreciated, right? So net book value will be after depreciation 25% per annum. So you don't take into account like the Sri Lankan way of valuation. Now here what happens is that, I mean, our valuation is that, I mean, second-hand market sometimes higher than the purchase price, right? So, but it may be so. We will have to go for go by a approved valuation report. Stocks are booked as stocks in goods under bank control. Now, like, I mean, these are kind of, the stocks pledging. If the stocks are pledged, pledge over stocks in goods, which is under the bank control, 50% of the market value. Now, it never happens. Banks don't keep the keys of the stores of customer, right? That is what originally used to happen. So here it doesn't happen under these circumstances. And right, hypothecation of stocks in stocks in trade is 30% of the market value. Quoted debentures 90% of the latest market value. So these are the realizable values. Normally, these are the indicators for the realizable value of different securities we are taking as a security for the lending. So rest of it we will see at the next class. We will wind up with this. Any questions up to now? Any questions up to now? Yes? Okay, if you don't have any questions, we'll wind up for the day. Yeah, one second.
What's the marketing management new subject, but I'm not yet here.
This evening, students, are you all listening? This evening,
Yes,
your new subject, marketing management, is going to start this evening. Are you all aware?
Yes, sir.
Right. Okay. So today your marketing management is commencing this evening. Right. Okay. If you don't have any questions, good day to you. We'll meet up next Sunday. And let's say the moment, if I can, run through these well in advance, I will share a question paper and then we'll start discussing a question paper. All right. Okay. All the best to you all. Bye.